So like I said, the other very critical element of term sheets are the rights which your investors ask for. There are several rights which you may find either in your term sheet or you may find in your definitive documentation, all of which have an implication on you as a founder, either commercially in terms of the stake you have in the company or in terms of the obligations and organization which you're supposed to create. So I can divide these rights, let's say, into three. There are a set of rights investors ask for, which are typically known as protective or participative rights. Some of the rights here could be, a board seat. So if an investor comes in with a certain reasonable stake, 20% upward, they may ask you for a board seat to say that I need the right to be part of your board and take part in all the critical decisions you're making. Non-compete, non-solicit rights typically with the founders to say that, okay, if you're part of this business, please devote your entire time and concentration to this business. And if for whatever reason you have to exit this business, then you will not compete or set up a competing business for a period of time, and you should not solicit employees from this business for a period of time. There is a list of items called affirmative action items or reserve matters, which you will see either at the term sheet stage or in your documentation. A set of fairly critical, decision points where the investor says that I should be part of these decisions and I actually have a veto on these decisions. You shall not take these decisions without consulting me first. So intent behind this is not for the investor to run the business or interfere in the day-to-day working, but to protect the investor's value. So this could be items such as your next capital raise or fundraise, which has an impact of dilution on the investor's stake. So they may want to control it, an ability to do an IPO or to consider a strategic sale or to make key hires such as a CFO or a CTO, etc. These are all things which will be listed out on the reserve matters, and you should go to the investor for consent whenever you want to take an action as part of the reserve. Apart from that, investors typically will ask for some information inspection rights. They will ask for the right to receive information from you, let's say in the form of a very standard MIS or in the form of plus in the form of financial statements as well, which again, this is part of every investment. There are a set of commercial rights which investors may ask from founders to protect the value, to sort of enhance the value of their investment, especially if they see a company which is doing well, one of their portfolio companies. They would want to double down and increase their stake and at least maintain the stake in the company. So a key among this could be the preemptive right. So a right to investors to say that in the event you are undertaking a future fundraise, you should give me the right to participate in such fundraise at whatever valuation you have discovered to the extent of my stake. Thereby, I get to protect my stake. So if I hold 20% stake in a company, I want to participate in 20% of the next fundraise so that my 20% remains where it is and I don't get diluted below that. Because if the company is doing well and I'm interested in participating in and investing more in this company, even at a higher valuation. Most sort of investors insist on a founder lock-in. So as a founder, the investor relies on you to run the business and to sort of have skin in the game in this business. So they would not want you to exit the business while they remain invested. There could be some exception made to the extent of a small, let's say 2% or a 5% stake for the founder to seek some liquidity. But investors will expect the bulk of the founder's sort of stake to remain locked in as long as they remain investors. Another critical right which comes up is the right of first refusal or offer. Again, part of the same theme to really enhance the stake in the company, especially if they see that the company is doing well. So a ROFR or a right of first refusal, the way it will work is that in case you are going out into the market and trying to raise a new round of funding, you are obligated to go to the investor, disclose the terms in which you are getting in the market to the investor, and give the investor the option of subscribing to that entire fundraise by themselves, and basically asking you to reject the offer which you got from the market. So that's what is known as a right of first refusal. Right of first offer works in a similar fashion, but rather than going to the market and soliciting an offer, you go to the investor first and allow the investor to make an offer. So by this, investors ensure that if they see that the company is doing well and if they believe they have the appetite to fund additional capital to the company, they actually are able to do it. Anti-dilution is a very critical right which founders should be aware of. So when investors invest into a company at a certain valuation, the expectation and the obligation on founders is that they maintain and enhance the valuation in all the future rounds of funding. For whatever reason, if things don't go well, if you're forced to do a fundraise in the future at a lower valuation, your existing set of investors with anti-dilution rights will expect you to give them more stake to basically compensate them for the lower valuation. Else, they have to go and disclose a mark-to-market loss in their portfolio, and they expect the founders to compensate them at least to some extent for this loss. Indemnity is a right where they see the founders taking actions or breaching the agreement, and the investors see a loss in their investment because of it. They actually have an indemnity right to say that the company needs to pay me to ensure that my loss is made whole because of whatever action has been taken. And a very critical right is a liquidation preference right. So your investor basically tells you that we are in the business of making investments, in the business of running your business, and we are professional investors. So we reserve the right to take out our capital in the event of a liquidation event or in the event of a sale happening. We will take out our capital first before we allow you as founders to take out your capital. So in some sense, the investor's capital gets taken out first. So it's critical that a threshold gets established here as far as founders are concerned. If I raise $20 million in funding from a set of investors in all my past, and then I know that I have to sell the company or I have to undertake liquidation at a higher value, at a value higher than 20 million. If I do it at less than $20 million of value, the investors take home all the proceeds, and as a founder, I get it. So these are some of the commercial rights. What you'll also see in a term sheet is what is called as an exit waterfall. So as we know, investors, professional investors, PE-VC investors invest in your company with a view to exit at some point of time and realize returns. And they will actually lay down timelines and the manner of such exit in what is known as an exit waterfall. The most preferred route for investors to exit a company would be like a qualified IPO, an IPO or a qualified IPO. So you get the company listed, and the investor, the shares get trading on the stock exchange. The investors are able to exit at any point of time they sort of choose. A qualified IPO is exactly the same as an IPO, but just a clause to add that if the investor gets a certain threshold return, then they cannot block the IPO and they have to allow the IPO to go through. So it could be like 25% or 30%. If an IPO doesn't happen for whatever reason, another preferred means of exit is strategic sale. So you and the investors have built a business of value, which could be valuable to other strategic sort of players, and you will sort of sell the business to them and thereby give the investors an exit. So that's another way of providing an exit to investors. Or if this doesn't happen, then or let's say the company hasn't scaled up to a point where it is either big enough to go public, or it has reached a scale where it's interesting to strategic acquirers, but still the company has grown. Then there could be other private equity investors, other financial investors who might be willing to step in, provide an exit to, let's say, your earlier set of investors, and carry the company through to an IPO or a sale. So these are, the more optimal means of exit as far as the investors are concerned. If for whatever reason these things don't happen, then you'll have to, rely on a certain other set of exit measures, like let's say a company buyback. So I'm not able to get an exit from this company, and I've tried to do an IPO or a sale, it has not worked out. So I will request the company as an investor to buy back my securities and give me my target return, or give me a certain minimum return on this. So the company will utilize its cash reserves to sort of carry through this buyback. There are some regulatory implications when it comes to a buyback. You may not be able to buy back the entire investor's stake in one go, in one financial year, in which case investor will tell you, then please do it across 2 or 3 years. This again is not optimal, because in most cases companies may not actually have the cash, or if a company is doing so well it has cash, then an IPO or a sale could be a much better and a much higher valuation mode of exit as compared to a buyback. But still, this is a right you will see in which investors ask for. If a buyback doesn't work, then things haven't worked out well. Then the investors will have what is known as a drag along right. So this is more an option of last resort. The investor has the right to say that, okay, for whatever reason, I do believe that the business has value, but the founders are not giving me an exit, or they're not carrying through any of these measures very seriously. In which case, I as an investor have the right to seek an exit, to find let's say another strategic player, and force the investors and the other shareholders to sell their stake to consummate a transaction. Because any strategic investor will ask for 51% or 76% or higher. And as an investor, I may only hold 25 or 30%. But I'll actually force the other shareholders to sell, and that may make a transaction happen. What's also critical to understand here is that investors also have a liquidation preference. So if they carry through a transaction at a lower valuation, then the liquidation preference also kicks in, and they actually get access to the entire proceeds. This is not a happy event for the founders, because they're being forced to do something. But if an exit doesn't happen through any other way, or an exit is not provided, then some of these conversations also. Finally, there's something called a put option. Again, not something which is part of a standard exit waterfall. typically triggers if there's a bad act in terms of from the founder's perspective, or there's a breach of the agreement, serious breach of the agreement, where the investor says, okay, my investment thesis is gone because you guys have committed a bad act. Now the founders of the company need to take over my shares and give me my capital back. So this is something fairly serious because it actually goes behind the personal financial resources of the founder, not just the company, which is why it gets triggered only fairly extreme.
Revolutionize your startup's equity management with Qapita. Request a demo today.